The yuan and the ruble are backed by physical gold.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, brought to you by Kinesis Money, and this is the show that goes beyond the headlines to uncover the truth about the precious metals industry. And joining us today is Kinesis' very own renowned whistleblower and precious metals industry expert, Mr. Andrew Maguire, is in the vault. And this week, again, we'll be answering more questions from the Live from the Vault community. So make sure you keep on getting those questions in. Just look at the link below. You can record in your own voice if you want, and you never know, you might be on the show here in the next edition. So with that, let's head over to the UK and talking gold with the one and only Andrew Maguire. Hey, Andrew, we've sifted down this week's subscriber questions to really two main subjects, and how fast gold-backed BRICS commodity transactions are being adopted. And following the July end-of-month paper gold-driven sell-off, I guess that's what you'd call it, how long, gold price capping between 3,400 and, say, 3,500 can go on, Andy? What do you say?
Yeah, great to be with everyone. Nice to see you again, Shane. Yeah, excellent questions. And do you know what? It's one of these things where I thought, what I'm going to do here, I get so many questions every time. Like, even though stair step after stair step, we go higher and higher and higher, yet intra-month, you get, I see comments of people going, oh, it's all collapsing again. It's all going down. It's never going to end. Well, look, what I wanted to do was I want to nail this once and for all. I want to actually really go dig into what's happening, how these end of month sell-offs are orchestrated, but also to illustrate how limited the scope of these constructive events are, and how constructive they are in themselves. And understanding them enables us to deconstruct this deliberately planted bearish narrative. We get it. We got to see it. Remember, Citi coming out and doing it. Hey, they've gone long now. Guess who was on the long side of all the shorts? Yeah. So it's a question now. Look, there's always a bearish narrative that either precedes or accompanies these events. And basically, we need to weigh up the paper to physical inflection points where bad actors dare not go. Now, outside the siloed world of the CME, LBMA casino, the strong, real physical supply-demand fundamentals are increasingly being determined outside the paper-settled LBMA CME ring fence. So each of these fiat gold selling episodes, one that we've just witnessed again into the end of the month, are simply consolidating the next in a series of higher physically supported stair steps. Each rinse cycle sucks more discounted fiat gold and silver into real physical exchanges. Now, to give an idea of scale of these end of month sell-offs and why they offer stacking opportunities, I'm going to seek to understand the myriad of these questions, asking how these sell-offs are generated. So using the most recent end of month paper-driven sell-off as a really good example, I'm going to drill down into the two factors that enable, but most importantly, limit the scope of these synthetically driven sell-offs. Now, we've been drawing a lot of attention to how the only tools left in the LBMA CME gold price suppression toolbox are failing and are ultimately leading to an imminent US Treasury gold price revaluation. Now, the scope of tool number one, which is the gaming of the COMEX exchange for physical premium. In other words, there's a COMEX price and it has a premium versus the Basel III compliant backdoor, which is usually a lower price. So one starts off high and then they kind of marry together as the contracts expire. So I want to go through them because it really confuses a lot of people, and it really should be simple. And I think by using a chart, we'll look at how simple actually it is. Because what's happening is that this tool number one is essentially the COMEX market. We're witnessing the COMEX market, the exit of the liquidity, and that's going into the global physical delivery markets. And then there's a tool number two, which is just it's the in conjunction with this first tool. What you do is drag in, led by the nose, a dwindling number of paper market speculators, lead them by the nose to take the bait, smack into them. Let's look at both of them. And really the first one is the key. For those that don't trade futures, now it's worth just understanding that when a leveraged, unbacked futures contract for gold or silver moves into expiry, as the August contract just did into the end of July for delivery on the 1st of August, it loses all its premium, which is called contango. And then it trades at the same price as the deliverable spot Basel III compliant global facing foreign exchange market, where it's possible to actually take delivery of a physical bar. Now, everything's going to make sense because as the August contract expires, it reached the same price as the deliverable contract. It makes sense because that contract just expired. So traders who don't want to be forced into taking delivery of their August COMEX longs or the shorts being demanded for delivery, they either exit or close and then roll further positions into the next liquid contract. In this case, it was the December contract, which at a rollover price that traded $59 higher premium to the deliverable spot contract. So that'll all make sense when we look at the charts. Now, the futures premium price over the spot price, what it does is allow for the carry costs. There's insurance costs, there's storage costs, et cetera, until the December contract goes into delivery on the first day of December. So obviously there's a period between August and December. But as a side note, given that gold is only fractionally held, the cost to carry is actually arbitrary. However, with the general mechanics understood, let's dig into the charts to uncover these footprints. Now, this August to December gold futures rollover chart, and this is where the August contract closed, and this is where the December contract opened. So just going to use this as a perfect illustration of how utilizing COMEX position concentration, i.e. the cartel controlling the majority of the chips in the casino, insiders acting for officials were able to immediately, now this is where it closed in the August price closed, immediately spiked up $59. And the officials were immediately able to short sell this $59 quickly all the way down to to an exact gap close, to where suddenly, this is the one that was called into delivery, the August contract that was called into delivery. So this is really this is a December contract, not going into delivery until the 1st of December. So suddenly down it goes. So this is, and basically, so right to the exact point where it closed on the 30th of July. Now, I just happened to be recording this at the pit open on Wednesday. And really what I'm just doing here is illustrating when a highly leveraged borrowed futures contract reaches first notice day, which it did right here, in this case, the expiring August contract, which had moved into physical delivery on the 30th of July, it forced holders of these undeliverable 96% leveraged long and short futures positions to either pay up the remaining $320,000 per contract to either take delivery or to exit the expiring August contract, which was trading at this point, a deliverable Basel III spot gold price. Now, what we're going to demonstrate here is, given these futures market positions are not backed by physical gold and are therefore underpriced, they're once again being targeted for delivery by tight for supply global-facing physical exchanges. Now, the next chart I show you is going to provide proof of that because it happened exactly at this time here. Now, this is the spot contract, not the futures contract. And here is first notice. In fact, the moment you had to pay fully up your last $320,000 rather than just the small amount of 4% that you owned of that contract. So all the speculators would have bailed. Now, here's where the price to cover the shorts that you'd created into this synthetic dip cost $9.30 more than the August contract. And what this meant was that the shorts, the cost for shorts to exit paper coal delivery obligations into the in-delivery August contract was as high as over let's just say $9. Well, in fact, it was slightly over. But meaning that even at $9, it cost a premium of $900 surcharge per contract over August. Now, given all the speculators would have exited long before first notice, and really probably would have gone short into first notice, the downside price overshoot of it was in really the hands of official short sellers stuck. And at this point here, with 20,500 contracts to deliver, so the cost to buy back or deliver was around $18.5 million. Well, there sure as heck wasn't any bullion bank involved in that trade. And it was 100% the Fed because every bullion bank is long gold for their own book. If anything, they would have been hedged. So when a further out contract rolls onto the board, and that, in this case, the December contract, that becomes the next most liquid front month, attracting all of the COMEX casino open interest. That's the speculators, etc., etc. So these 96% leveraged chips really constitute that open interest. And of course, it has to account for the carry cost to expiry. So in this case, when the December contract was launched in March 2025, and we capture that here, March 2025, then you can see that the carry costs would to carry this contract to all the way to this contract expiry, which is actually the December contract expires on the 27th. That's first notice day, but rolls into delivery on the 1st. That was well over, well, let's just say $110 an ounce. In this case, it was a high of about $120.60 per ounce. However, these carry costs have legitimate purposes. Obviously, there would be hedging, refining, physical bullion or futures production, a whole manner of things. It serves a good purpose. And it also provides bad actors with a directional agenda to act nefariously. Now, note how this $100-odd premium, leveraged at around 96 to 1, had enabled gold to be pinned for 4 months in a row, capping gold from rising above, let's just raise it up here, capping gold rising above $3,500 to $4,000 an ounce. Well, $3,400 to $3,500 actually. But as we will demonstrate, and here just as a perfect example, again, this is where a prior contract opened, and then suddenly down it goes. And then again, with same process. And the reason I'm doing this again is to understand why it's not going to work anymore. But nevertheless, that $100 premium leveraged at 96 to 1, really, it has maintained a cap, but it is backfiring. And guess who against? The only actor still trying to cap a rising gold price, which is the Fed. Now, if you remember, Putting this into context, 2 months ahead of gold being reclassified as a physically deliverable Basel III NSFR first tier high quality liquid asset on the 1st of January. And this they covered just before that. It's basically 2 months ahead of that, in the know that gold was going to rise. So they covered all their remaining 500 tons of gold derivative bets. And they did that alongside every single global central bank, sovereign and bullion bank, ditching all their gold derivative risk and going long for their own books, all in tandem, anticipating higher prices. Goodness, even the outlier Citi has now reversed its bearish gold stance, now calling for 3,500 in November. If you remember, it was Citi that was calling for hundreds of dollars lower and failed to get it. Now, if you remember, we drew attention to these bets, and these are foreign exchange bets, unallocated foreign exchange bets that trade outside of the futures market. These bets were made by the Fed. Now, their agent bank, JP Morgan and Citibank, were the primary. Goldman has long escaped capping gold. So the two primary banks that we drew attention to, and if you look at the precious metals 5 years maturity bets, so JP Morgan and basically Citibank were the only two making derivative bets out for 5 years. So now, look at where we are now. They've covered. So it says everything. And as we've assessed in the past, these bets are undoubtedly linked to the 8,133 tons of rehypothecated US Treasury gold. And so that's proof of capitulation, because since the last report, JP Morgan and Citi have exited their longer term bets. This gap close also captured in the daily charts, which we've seen in the past time after time. But essentially, the only bad actor willing to risk exposing themselves to fight the losing proposition of a rising gold price against the dollar is the Fed. And as we just witnessed, the lack of futures market Basel III compliance has once more enabled them to employ futures market leverage to synthetically dilute the price into an end-of-month mark-to-market event. And if we drill down into, say, the very short-term charts, it's pretty clear. This was 100% an official driven overshoot of very strong physical demand. And it was jumped on by the physical exchanges. The reason they did it here was exactly, this is the point where they have to value these huge bets that were made, billions of dollars unallocated foreign exchange gold and silver direct bets. And we also saw the same in silver. The same event, because they also have shorts in silver, undeliverable, unallocated silver shorts, which are also being capitalized on by physical market players. The latest official EFP short selling commenced into the morning of the 30th of July, and the August 1st notice event here, where all speculators were either cash settled, their 4% held August bets, or rolled over into the new front month's December contract, which actually this is the one we're looking at here, at a $59 higher price. And while this synthetically driven gap close actually enabled them to cash settle undeliverable underwater options bets, moving into fully paid up first notice, the real focus was on much larger OCC bets linked to the repayment of Fed borrowed BIS leases valued on that day. But despite all their efforts that we've sequentially seen despite this last 4 months of capping, we talked about the hundreds of dollars that they'd leveraged to cap it, running out of steam. And they failed to get a lower close. So these footprints just capture how these mark-to-market derivative events work. But given the direct liquidity provider feedback of very large central bank sovereign and institutional orders filled into this dip, into the dip ahead and into the dip after, not to forget, each of these events are fully anticipated by the BRICS physical exchange is stealthily converting Western asymmetrically imbalanced paper gold into physical. Now, we'd mentioned tool number 2, and that's quite simple. As is always the case, momentum-driven upside and downside overshoots. Commercials are always on the opposite side. In this case, they were once again one-to-one on the long side of the naked short downside overshoot, and there were only 2 fixes below it, just below 3,300 spot. Now, this is the futures chart, so it shows higher. But it tagged them. Guess what happened? Now, there's tons of explanations of why this happened. It happened because of physical buyers. It happened because China and Russia and the BRICS countries capitalized, had already been loading the boat, waited patiently, as we said they do, and then literally as soon as those central banks' bids were filled, all the fixes thereafter were higher. Just ignore this really short-term stuff, and we're just providing ourselves a little context on an intraday basis. So the moment first notice was dusted, the race to short cover the enormous central bank and sovereign demand that had been triggered into the momentum-driven overshoot of the 2 spot fixes, sub 3,300. So literally it forced the insiders to ring the register on the momentum shorts, also capturing the bullion bank longs, running into bullion bank longs alongside official short covering in excess of what could be laid off against the momentums. Hence, the $18.5 million bill to cover. And whose bill was that? Fed. So as we've said all along, step by step, higher stair steps are being built into each and every synthetic gamed dip. We'll look at that closer in the BRICS section. And despite all the gaming in silver, no damage done. All it's done is coil silver for a very strong rally into deeply oversold conditions. And we'd be really surprised if 40 wasn't taken out in short order. As soon as we start seeing short covering, we would expect 50-odd, 53 to be the next staging point. So given we've had so many questions on how these COMEX markets wash and rinse cycles work, I wanted to spend some time explaining the mechanics so others can mirror what every central bank is doing, ditching, depreciating unbacked fiat dollars for real money, gold, and understanding the limitations of these events so stackers don't get fooled into waiting for the kind of lower prices that Citi just capitalized on by taking everything that was on offer after they tricked CTAs into selling. Now, the Rob to Peter to pay Paul mark-to-market event will once again need to be paid back at higher physically determined prices, hence the higher stair step. This was evident as the August contract rolled off the board. The spot premium to square these obligations had risen to $9.30. Now, as has been the case into every synthetic-driven short covering event since Basel III compliance, it's ultimately served to secure the next globally priced, physically driven higher stair step. So in summary, the fulfillment of the December to August $59 EFP gap close that you just saw enabled officials to drag out non-compliance for just one more month. So they seek to sit on, what they're trying to do is seek to sit on the December 3,000 sweet spot. They want to keep it at 3,000. We've shown how for 4 months they were managing to keep it in a range. But this is their hope, is to try and pin it to 3,000 into November the 24th, when it will be at par to spot delivery. Ain't going to happen. Whatever the latest, so really the latest attempt to be able to sit on paper gold into a strong, physically determined higher price will once again backfire. In fact, this whole wash and rinse cycle has simply two-way rinsed out all the long and short speculators so as to set up the next leg of a rally from this higher stair-step. So 17 months into yet another wrong-footed paper market mark-to-market event, the physical disconnect at current prices is so large that with insufficient speculators left to lay off any meaningful size against, in other words, there's no one to lay it off against, liquidity providers assess the scale of the disconnect mirrors the $500 $29.70 to $3,504 April short squeeze setup. As you can see, I've just showed this we showed this in our last episode, but I've updated it here in this chart. Now, while there will be, there's going to be two-way tariff, geopolitical ebbs and flows, of course, short-term stuff. I mean, you can see it all the time. But liquidity providers report physical shortages into very, very robust safe haven demand. That's the underlying driver.
All right, Andrew. Now, silver also got caught up on the OCC bets being marked to market into first notice. Now, what are you seeing here?
Yeah, with the physical silver trade now largely bypassing Loco London, we looked at this last time, these same actors in silver futures are still exposed, well, not just silver futures, but also to unallocated spot silver, are still exposed to these Office of the Comptroller, OCC derivative bets, which are being targeted for delivery by the physical markets and have become increasingly difficult for the Fed to cover. And this is evident by way of declining open interest, or let's say the number of chips in play. Now, with the COMEX silver market paper settled liquidity, alongside producer financing initiatives, all leaching out into the Chinese physical exchanges where they're properly benchmarked, silver has now largely escaped the LBMA stranglehold. Now, these same actors are having difficulty in containing silver. Now, the reason it hasn't spiked any higher is that the savvy buyers, the controllers, are in China, and they're sitting back and letting the specs and the paper market guys do their thing. They've got control. They can let this run to 50 tomorrow. They can let it run to 100 tomorrow. But it doesn't suit them right now, but it's coming. Now, also, let's not forget, Russia is the 8th largest global silver producer and is estimated to produce about 1,400 tons of silver in 2025. Now, with the Russian central bank and the military complex recently diverting local production to stockpile silver, liquidity providers assess that this additional global offtake is not factored into the current supply-demand silver price, which is already in a deficit. And it is so disruptive, it tips the global supply deficit to force other competitive buying from China, India, and also from consumers who are going directly to the mines to produce, to source supply. Now, while spot silver is not Basel III compliant, it's important to understand this. Yes, it's not Basel III compliant, but it is a deliverable foreign exchange cross against the dollar, pound, euro, etc. And as with silver, and because silver supply is getting priced outside the LBMA's control, the Loco London Global Silver FX Fix, benchmarking the global physical supply demand settlement price, will have to rise to meet this fresh demand. And that's further going to drain Loco London's supply, which is already at critical levels. Now, the silver fix actually benchmarks a direct producer to end user price. And so any discrepancies are simply being arbitraged. And liquidity providers report continued accumulation of underpriced LBMA CME silver is currently now in the BRICS crosshairs, as it have been for some time, but it's stepping up. And very, very, very short term, silver under $38 is unsustainable.
Well, Andrew, that's actually amazing. And now our number one question last week from the community was They want Andy Maguire's BRICS update. What do you have for us today?
Yeah, so following on from our last episode, where we delved into the gold-backed tokenization and financialization of really potentially trillions of real-world assets, and based purely on supply-demand gap filling, this leads to a fair value price of 8,000 gold, and that is conservative. And as we recently indicated, silver well into the 3 digits. Now, while this tokenization gateway opens up every single commodity to be traded and settled intra-BRICS national currencies, we've been focusing on the West's gross underestimation of BRICS nations' ability to take full control of the gold and silver price setting mechanisms, and how, through the formalizing of the financial infrastructure to support a sufficiently liquid global settlement price, the CME LBMA will increasingly become price takers and not price makers. It's so important to understand this. It is a change of behavior. This is happening under our noses, and as we will see, it's central bank driven. China has actually accrued sufficient physical market liquidity to benchmark a self-arbitraging, fungible, global, sanction and tariff-proof gold price for T+0 settlement. We looked at this kind of last time, and don't forget, there's some important things that a lot of people don't understand here. China's cross-border payment system, which really you've talked to when you look at Bloomberg and all it's really not mentioned. It already interconnects with almost 5,000 banking institutions, and that is growing on a day-to-day basis. Now, this CIPS settlement platform, the CIPS settlement platform, overtook SWIFT transactions back in April. We thought it was May. It was actually back in April. Now, what is really missed by Western media reporters is that the Chinese yuan and the Russian ruble trade on the Basel III NSFR compliant gold standard blockchain rails because they're fungible. Both currencies are one-to-one backed by physical gold. Now, you can either hold those currencies or exchange them at par for physical gold. I mean, that is what used to be, the US dollar used to be backed by physical gold. The yuan and the ruble are backed by physical gold. Now you net this out. The ruble price of gold is consistently around $10 higher than the local London benchmark price. I've looked at it again today. It's every day it's around $10. And alongside the yuan price of gold is consistently around $5 higher than the intraday local London price. That's netted out. Now, prior to local London fixes becoming Basel III compliant in January 2023, it was not unusual to evidence, if you remember, we used to see $50, and in fact, as high as $100, but we used to regularly evidence $50 higher prices, yuan gold prices, than London, and how this regularly drove a massive arbitrage opportunity as underpriced Western exchange traded fund and COMEX gold and spot gold, unallocated spot gold, was drained to capitalize on these real world premiums. Therefore, due to its global fungibility, and this is the key because gold is fungible globally, when the price of gold in yuan is higher than the LBMA fix, nations seeking to pay for or deliver commodities in exchange for their national currencies, they'll simply buy London spot and arbitrage the difference. This has created a backwash into the LBMA fixes, forcing really unwanted discipline upon it, because the unallocated gold in London, other than at the fixes, has up to a 20% haircut. Now, as we drew attention to during the BRICS summit, backed by central bank sovereign and fresh safe haven physical demand, China's expanding Shanghai vaulting network that's been established. It's being established in Singapore, in Hong Kong, Saudi, Russia, Brazil, Africa, Southeast Asia. It's global already, and they're already, this group, these vaults have already aggregated sufficient physical market liquidity to benchmark a global, physically determined supply-demand gold price to be locally delivered. Now, tokenizing BRICS collaborations into stablecoins and backed by real assets, along with a race to secure as much gold as possible to back the value of each nation's foreign exchange currencies, provides the BRICS nations and their counterparties with a very liquid 7-second settlement process, maximum 7-second settlement process. And bearing in mind that you've got vaults around the world where literally a T+0, because it's fungible, a T+0 delivery can be moving gold from one side of a vault to the other nation's holdings place. So while everyday BRICS pay transactions that people look at are not directly backed by a weight of gold, they're ultimately underpinned by a yuan gold standard. So sales of goods and services and commodities are valued against gold. So that's how they're benchmarked, and then directly convertible into physical gold. This is what is going on. It's just not realized. Ultimately, with gold increasingly backing real world assets, the US administration, we said last time, they've got two choices. Either head into a losing battle against the global majority, which kind of is what they're attempting now with all of the BRICS nations under the crosshairs for tariffs and one thing and another. It's going to backfire. Then the only other choice they have left is to revalue gold to compete. So the four precious metals being benchmarked at the global facing FX fixes have now secured really sufficient physical market liquidity to force the LBMA CME cartel to become price takers. So, and guess who's setting the COMEX price right now? So as we've just highlighted, really, the Fed is once again facing buying back borrowed Bank of International Settlement gold leases into a 17-month series of physically determined higher prices. And the last tool in the toolbox, we're just pointing out, is blunted, and there's just not enough speculators left to lay paper gold liabilities onto to offset how much unallocated gold and silver is being alchemized by China and Russia right now, right under our noses. Well, that really just leaves one question. We global gold and silver buyers are no longer in the minority. We used to be. We're not in the minority anymore. So my question is, have you also joined the global majority movement who are as quickly as possible converting their rapidly depreciating debt-pat fiat currencies for physical gold and silver? That's my only question, guys.
All right. That wraps up another episode of Live from the Vault, brought to you by Kinesis Money. And a big thank you to Andrew Maguire for sharing his deep market knowledge once again. And thank you also for tuning in and being a part of this growing global community. So if you're new here, make sure that you subscribe, hit that subscribe button. Also tap the bell there so you'll be the first to know whenever this episode and whenever following episodes go live. And if you've been with us for a while here, just keep help spreading the word by giving us a like, not now, but right now, and share this episode with someone who needs to hear it right from Andrew Maguire. So get your questions into Andrew Maguire. By the way, all you got to do is just take a look below. There's a link and you can record in your own voice, and you never know, you might be on the next episode of Live from the Vault. And until then, make sure you remember, buy physical and make sure it's backed 1-to-1. We'll see you next week. Bye for now.